Question 23. Shield Security pays annual dividends and has just paid this year's dividend of $1.20. If its equity cost of capital is 10% and dividends are expected to grow by 5% per year in the future, what is the value of Shield stock? Make sure you're using a proper dividend. So here we're provided with the dividend that has just been paid. So this is our D0. We have to make sure we use D1, so dividend from next year, right? So this is a simple growing perpetuity model where the price of the stock is dividend in year 1 divided by R minus the growth rate of the dividends. Here we're given dividend 0, which is equal to 1.2, and we're given the growth rate of 5%. Based on that, we can figure out that dividend in year 1 is going to be equal to 1.2 times 1.05, so 1 plus the growth rate, and that gives me 1.26 for dividend for year 1, and now I can compute the price, which will be equal 1.26 divided by R, which was 10%, minus G, which was 5. And that gives me the price of 25.2. Which is answer E. Okay, let's look at 24. Fanshawe Corporation is expected to pay an annual dividend of 20 cents per share in the coming year and to trade for 15.15 at the end of the year. If investments with the same risk as Fanshawe stock have an expected return of 10.75%, what's the most you would pay today for Fanshawe stock? So this is similar to the problem we did a moment ago. So present value of the stock today is price of the stock today is present value of future cash flows. In this case, we know price in year 1, we know dividend in year 1, and we're gonna have to just discount it once. So in this case, price in year 1 is equal to 15.15 plus dividend in year 1 20 cents divided by 1.1075. So 1 plus the growth rate, 1 plus the cost of capital, and the price today becomes 13.86, which is D. Okay, let's look at 25. The GAP's most recent earnings per share won 1.75. Analysts forecast next year earnings per share are at 1.88. If the appropriate price to earnings ratio is 15, a share of the GAP stock should be valued at. So here we're using the comparables method of valuing the stock. We're given the information that most recent earnings per share for GAP were 1.75. Next year's earnings per share are expected to be 1.88. Price to earnings ratio from other companies or perhaps from industry is 15. What's the price? Well, price would be taking price to earnings ratio and multiply it by earnings per share, the future ones, because we always want to base our information on expectations on the future. So in this case, it would be 15 times 1.88, which would give us 28.2 as the stock price, which puts us at answer B. And let's look at 26. Airlon Airways, a commercial airline, suffers a major crash. As a result, passengers are considered to be less likely to choose the airline as their carrier, and it is expected free cash flows will fall by 20 million per year in 5 years. The airline has 65 million shares outstanding and equity cost of capital of 12%, no debt. So by how much would their shares be expected to fall in the price as a result of the accident? So here we're trying to compute the present value of the losses created by the accident. This is a similar net present value analysis like anything else. So let's take a look at this. So what we know here is that the company is expecting a fall, so free cash flow of negative 20 million for 5 years. So basically this is an annuity. So we can just use the present value of annuity on our calculator or in Excel. We can use calculator. We could have used the net present value button, but here it's very easy to just use the calculator. So we have 20 million negative cash flow, which is our payment for the next 5 years. And we're using an interest rate of 12%. And that gives us present value of those losses at 72.1, which is a negative number. 72.1. Other way would be, of course, to just set this as cash flows. So my cash flow 1 would be 20 and a negative number. Oops, 20. Negative number, enter, and I would set the frequency of that cash flow at 5, and then I would compute my NPV. Alright, so this is the present value of those losses. We have to see how they translate to the stock price. They have 65 million shares outstanding, no debt, no cash provided. This present value is like loss or maybe decrease in enterprise value, right? And when we want to translate something from enterprise value to price, we know that price is equal to enterprise value minus debt plus cash divided by shares outstanding. So here decrease in price would be our decrease in enterprise value divided by shares outstanding, which is 65 million. No debt, no cash, as I mentioned, and that gives me negative 1.11, and this is my decrease in price. And that's answer C. All right, let's look at 27. An equity issue that raises new funds for a publicly traded company is called. So if you have a publicly traded company and you raise new funds, it is called seasoned equity offering. Initial public offering is when you raise the funds for the first time. Underprice offering, I mean, that's just a descriptive. Secondary offering is when in your IPO or in your seasoned offering, you current owners of the company are disposing of their shares. Firm commitment offering is describing the relationship between investment bank and the company regarding who is responsible for selling the shares, and in that case investment bank must sell all the shares. All right, let's look at the next question. Use the table below for the question. The founder of a company issues 100,000 shares of Series A stock for his own $25,000 investment. He then goes through 3 further rounds of investment as shown below. Series B at the price of $250 to 200,000 shares, Series C $275, 300,000 shares, Series D price $280 at 200,000 shares. And the question is, what is the post-money valuation for the Series D funding round? So there are 2 things we have to do. So basically, first we have to figure out how many shares the company has after all the rounds, and what is the most recent price of the financing round. Well, this we can read right away from the table. The most recent price for the funding round is $280. And in terms of number of shares, we can quickly compute them. So there were initially 100,000 shares, then the company issued 200, then 300, and then 200. This together gives 800,000 shares. The most recent price was 280, as I mentioned. So we have 280 times 800,000 shares. That gives us 2.24 million. Which is D.